Coca Cola Company recently released their latest quarter's earnings, and while the stock is up around 20% over the past year, if we look at the past 5 days, they're actually down about 4%, which is actually quite a bit for a company that typically has pretty low volatility. So let's go ahead and jump into this earnings report and see if this presents an opportunity to buy Coca-Cola stock. So if we jump over here to Seeking Alpha, scroll down, we can see Q3 non-GAAP earnings per share came in at about 77 cents, which was a beat by about 2 cents, and revenue came in at about 11.9 billion, which was actually down slightly year over year, but it still beat analyst expectations by about 290 million. Now, if we start to dig into the financials of Coca-Cola just a little bit more, let's go ahead and jump over to my dividend breakdown sheet and come up here and plug in KO. And all this data will automatically load in. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, what we're going to notice about Coca-Cola is, to start off, obviously this company is a dividend king. They've been paying out dividends for over 50 consecutive years, which makes them pretty favorable for a lot of dividend investors. And right now, the starting dividend yield is sitting close to about 2.88%. But what I want to look at and talk about right now is free cash flow and what we just learned about free cash flow with the recent earnings report. Now, for the majority of the past decade, we can see free cash flow was covering that dividend. That's one of the key metrics we want to look at for most companies. Remember, there's 5 different things a company can do with their free cash flow. They can reinvest back into the business, they can pay down debt, buy back shares, pay out dividends, or attempt mergers and acquisitions. So if a company is using most of their free cash flow to pay out dividends, that only leaves a little bit of free cash flow left over to reinvest back into the business. So for example, in 2013, they generated about 7.9 billion in free cash flow, and dividends paid out was about 4.9 billion, which gave them a free cash flow payout ratio of about 62%. So 62% of their free cash flow was being used to pay out dividends. But we can see over the past decade, there's been years where it's been quite a bit higher than this. And if we look at 2023, they used about 81.5% of their free cash flow to pay out dividends. Look at this. The free cash flow they generated was about 9.75 billion, and dividends paid out was about 7.95 billion. So they were paying out a lot in dividends compared to the free cash flow that they're generating. Now, if we jump back over to the earnings report, they actually talked about guidance when it comes to free cash flow. We can see right here, the company expects to generate free cash flow, excluding the IRS tax litigation deposit, of approximately 9.2 billion. Now, if we go back over to our sheet, we can see in 2021, free cash flow was 11.2 billion, in 2022, 9.5, 9.7 in 2023, but they just told us it should be about 9.2 billion over the next year. So it's actually going to be a little bit lower. It might be somewhere around this range right here. So if their dividend payment is going to increase like it does every single year and free cash flow is going lower, then we're actually going to see free cash flow payout ratio even higher than 81.5%. So that's quite a bit higher than I typically like to see it. Now, to be fair, what you have to understand about Coca-Cola is this is a very mature company, and as companies mature, typically management teams will decide that the best way to reward their shareholders is going to be in the form of dividend payments. And this is where you have to really understand what your own personal goals are as an investor when it comes to whether or not you should buy stocks like Coca-Cola or not. What do I mean by this? Well, one of the things we have to understand about Coca-Cola is they have very predictable and very stable cash flows, and that's something that investors are willing to pay a premium for. No, they don't have the highest starting dividend yield in the world, and the dividend growth rates aren't the highest, but a lot of people who are looking for very stable income coming into their portfolio really like Coca-Cola stock. I mean, over 50 years of consecutive dividend payments. That is pretty impressive. But the reality is, because they're using most of their free cash flow to pay out dividends, they can't increase their dividends at a high rate. So if you're a long-term dividend growth investor, maybe this isn't something you should look towards, but if you're someone who's more mature in their investing journey and you're just looking for stable, predictable income, that's where Coca-Cola starts to become more attractive. Now, to be fair, we have to ask myself, am I a hypocrite? Because I have a long-term time horizon, but I actually do own Coca-Cola stock. In fact, if we jump over to my do-it-yourself investor toolkit and look at my position on Coca-Cola, we can actually see it's done really, really well. If we look right here, we can see I'm currently up about 48% on my Coca-Cola position, and I was up over 50% before this recent sell-off after the earnings report. So if I have a long time horizon, why do I currently own Coca-Cola? Well, you have to understand, I'd buy pretty much any company at the right valuation, and I bought Coca-Cola around 2019 or 2020 when I felt the company was undervalued, and obviously since then, they've done very, very well. But in reality, the question I have to ask myself now, is this a company I should continue to hold, or should I sell it and deploy my capital elsewhere? And that's actually a really interesting question. I'll have to address that in another video, but let's get back to Coca Cola. If we start to look at some of the key takeaways from Coca Cola's earnings report, there are definitely some bright spots despite the sell-off that we've seen. If we scroll down, we can see organic sales have actually done really well for the company. It was up about 9% during the quarter versus the expectation of 6.3%. And most of this growth came from Latin America. We could see up about 24%, so that's huge growth. And North America is actually really good as well, up about 12%. And this is even better when you actually compare them to their biggest competitor, Pepsi, who was up around 1.3% for the overlapping period. Now, like I said, scroll down, North America outperformed. Let's talk about margins for just a moment. In fact, if we go ahead and jump over to my stock screener sheet, and let's actually jump over to the profitability sheet. You can see I've already plugged in Coca Cola, so this data is loaded in. Now, when we look at the gross profit ratio for Coca Cola, it's actually pretty solid. If we look at the 10-year average, it's sitting at about 60.5%, and in 2023 is about 59.5%. So the gross profit ratio has remained very steady for the company over the past decade. Now, if we scroll down, here's what I want to point out. If we use the ticker data function, we can actually pull in what this gross profit ratio was in the most recent quarter. We'll just type in KO, type in gross profit ratio, and then we want the data for 2024, and then we want the most recent quarter, which is Q3, and hit enter. And this data will automatically load in thanks to ticker data, but here's what we can see. Gross profit ratio in Q3 of 2024 saw a nice bump up. It was a decent bit higher than it was for 2023. And again, this is another one of the bright spots for the company. When we talk about more mature companies that typically have slower mid to single digit revenue growth, like for example, Coca-Cola 5-year revenue CAGR is only about 5.9%. Where the huge opportunities for companies like this is to increase their margins, and that's what Coca-Cola was able to do over the last quarter, again, one of the bright spots. Now, if we jump over to our stock screener and come up here and plug in KO, there's a couple things here we can quickly point out. Now, we kind of got an idea of revenue by looking at the profitability sheet. It went down a little bit, but we're seeing some growth over the past few years. Now, earnings in 2023 was actually a decent bit higher than it had been in prior years, which was a good sign overall for the company. In 2023, earnings per share was about $2.48 per share. Now, if we go over to Seeking Alpha, let's start to get an idea of what the expected growth rates are for this company by looking at the earnings estimates. If we start to scroll down, like I pointed out, they're expecting around 6% growth or 5% growth or even 7.5% over the next few years, so mid-single digits. And then if we come down here and look at return on invested capital, again, this is telling us how profitable are the projects that the company is reinvesting into. So again, they're not using most of their free cash flow to reinvest back into the business. Right now, it's only about 20%, but the capital they are reinvesting back in, we can see, is getting a return of around 11 to 13%, it looks like. And that's somewhat decent. Typically, I want to see a baseline of at least 10%. High quality companies are typically going to be above 20%. Now, with all that being said, is Coca-Cola currently trading at a good value at $67.36 per share after the sell-off with their most recent earnings report? Again, down a little over 4% in the past 5 days, which is quite a bit for a stock with low volatility like Coca-Cola. So let's go ahead and jump over to my stock valuation spreadsheet, and we're going to jump right into it. And start off, we're going to look at a discounted cash flow analysis for this company. We're valuing the company based on how much free cash flow they're expected to generate in the future. So the first thing we need to do is project a growth rate to the future free cash flows of the company. And we do this starting out by looking at historical growth rates. Now, historical growth rate is going to be not the best way to analyze this to start off because we can see we have some negative numbers right here. But moving forward, I'm projecting a growth rate of about 8% to the future free cash flows of this company. We find the present value of those future free cash flows and add them together, add the company's cash and cash equivalents. Then we subtract out their total debt to get equity value, divide by shares outstanding, and we come to a DCF price per share of about $51.88, which is quite a bit lower than that current trading price. Now, the next valuation we look at is the multiples valuation, and this values the company based on how the market is valuing companies that are similar in structure. So we have companies like Pepsi, companies like Monster Beverage Corporation, and we can see the price to earnings multiple that the market is valuing them at. And these are actually companies that are valued at a relatively high multiple. We can see the average PE between these companies is sitting a little bit above 30. Now, when we apply the same price to earnings valuation to Coca-Cola and their earnings per share, we come to an intrinsic value of about $75.24. Now, the last valuation we're going to look at is going to be our dividend discount model, and this values the company based on how much they pay out in dividends and how much that dividend is increasing over time. And we kind of got an idea by looking at our dividend discount model. Typically, looks like their dividend growth rate over the past 5 and 10 years has been between 4 and 5% on average. So let's go ahead and stick with that, and we'll go with the low end since it looks like that free cash flow payout ratio is continuing to climb a little bit higher over the next couple of years. We're going to assume a dividend growth rate of about 4% and a discount rate of 8%, which gives us a dividend discount model price per share of about $50.44. Again, quite a bit off actually from that current trading price. So when we jump over to our output tab, you can see if we average these three valuations together, we come to an intrinsic value of $59.18 per share, and the current share price for this company is sitting at $67.32. So it looks like it's trading quite a bit higher than its actual intrinsic value. So the question we have to ask ourselves, why is this? Is the company simply overvalued? Well, there may be something to that, but we have to keep in mind this is undoubtedly an example of a company that will typically trade at a premium, and there's a few different reasons for this. And like we already know, this company has a massive brand. People worldwide know about Coca Cola and their products. And in fact, most people, especially in North America, probably drink one of their products every single day. And then we have another reason. Coca Cola is one of the largest positions in Warren Buffett's portfolio. It's actually the fourth largest and makes up about 9% of his entire portfolio, giving investors even more confidence in the company. And then, of course, like we already talked about, this company is what's known as a dividend king, meaning they've been increasing their dividend payouts for 50 consecutive years. That's an extremely impressive accomplishment and gives income investors confidence in the stock and in management. But most of all, I think it has to do with predictability and the stability of their cash flows. Coca-Cola is not the type of company where you could see a 20% reduction in their cash flows in any given quarter. It's very stable. So when I think about Coca-Cola stock, yes, it's a household name, and dividend investors do talk about how they love this stock, but if you have a really long time horizon and you're a dividend growth investor, this isn't necessarily a stock I would tell you to buy. The growth rates are somewhat low, including the dividend growth rates. But on the flip side of that, if you're someone who's more mature in their investing journey and you're just looking for very predictable, stable, and growing dividend payments, that's the type of person that should be considering Coca-Cola stock as an option. And the reality of Coca-Cola is rarely do they actually trade right at their intrinsic value. They're typically going to be a little bit above it. But with that being said, there are at times opportunities. If we look at the past 5 years, obviously 2020 presented a big opportunity when the company traded as low as about $38 per share. We can see in 2022, they got as low as about $54 per share, and in 2023 in October, as low as about $53 per share. And again, as for me, I don't plan on adding any more Coca-Cola to my portfolio. But go ahead and let me know what you think of this company in the comments down below if you plan on buying or selling. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.